Okay, so if we then take our total liabilities and divide by our total assets, we can see Amazon has a debt ratio of 0.72448. I said to round it to 2 decimal places. Oops. Oops, I'm in the wrong spot. That's why. It's freaking out. Okay, 0.72. So we're said a high ratio, 0.75 is where you start thinking it's too high. So 72% of Amazon's assets are financed by debt, but I don't think anybody's too worried about Amazon being able to pay their long-term debt. So, I mean, as a rule, 75% is where you start getting worried. We're kind of getting into that range, but Amazon, I think, has a pretty good outlook right now. All right, so then the next ratio that we use to evaluate a company's ability to pay their long-term debt is the times interest earned. So the times interest earned is basically what it says. It measures how many times the company's earnings can cover their interest expense. So we take our operating income and divide it by the interest expense. We see how many times the earnings cover the interest expense. Obviously, we want it to cover at least one, but the higher the better for a creditor. If it's a low ratio, then the creditor is maybe worried they won't be able to make their annual or semi-annual interest obligations. So let's take a look at Amazon's times interest earned. So operating income and interest expense, we need to go to the income statement to find these amounts. Okay, so Amazon is calling its income statement the consolidated statement of operations, right? But we can see it's an income statement. Here's their sales, here's their expenses. Our operating income for 2019 is $14,541. And then our interest expense, we can see is $1,600. It's being subtracted because it's an other expense, but $1,600 is the actual interest expense. So let's take a look at how that computes. So when we divide operating income, divide that by interest expense, it comes to 9.09. So Amazon can cover their interest obligations a little over 9 times. So creditors are going to feel pretty good that they're going to be able to make their interest obligations. So those are the ratios that you're going to discuss when you talk about the ability to pay the long-term debt for your 2 competitor companies. Then you're going to also comment on the profitability. Okay, so we've got 3 ratios that calculate the profitability. So the profit margin percentage tells you how much of every sales dollar the company makes in profit. Okay? So we take our net income, divide that by our net sales revenue. So obviously the higher the better. A typical profit margin is going to depend on your industry. So that's why I'm having you compare profit margin percentages for 2 companies in the same industry. So let's take a look at Amazon's profit margin percentage. We need the net income and the net sales revenue, which we know we will pull from the income statement. Okay, so we look on the income statement, we can see 2019, the net income is $11,588, and we can see the total revenue here, $280,522. So that's what we're going to be dividing. So when we divide, we get 0.04. We're going to go out to, we're going to actually show this as a percentage. That's what I've asked, and we'll show 2 decimal places. So if I take it a percentage and we go out 2 decimal places, 4.13% is our profit margin percentage. Okay, so that's not terribly high. Interestingly enough, Amazon is kind of interesting. What's the competitor for Amazon? They're so big. I don't know what their direct competitor is to compare that to. But you will have 2 companies so you can compare. So basically every sales dollar, they get just a little over 4 cents in profit. So it kind of seems like a small number. All right, next one, return on assets. So before we talk about return on assets and return on equity, I just want to talk about in general, what is a return? So a return, it's what you get back on your investment. So it's your profit on your investment. And we're going to show a return as a percentage. So basically, if you take your profit divided by what you invested, right, that's going to give you a percentage. And so you can think about a savings account or a CD. What's the percent of interest that you're earning on those things? Return on assets, we're going to see what did the company get back for what they invested in their assets. So we're going to take the net income and we're going to divide it by the average total assets. Your average total assets, we take the beginning of the year total assets plus the end of the year total assets, we divide that by 2. So let's take a look at Amazon's net income. We know, well actually we've already pulled that, we just looked at that when we did the profit margin percentage, but now let's take a look at how we get our average total assets. Okay, so to get our average total assets, here we can see our total assets for 2018 and our total assets for 2019. So the average for 2019 is the beginning of the year total assets plus the end of the year total assets. We need to divide, or we need to add that together and get a subtotal, then divide that by 2. Okay? So whatever we ended 2018 with, that's what we started 2019 with. So that's going to be our beginning assets. So we're going to take the 162,648 and add the 225,248. That's the end of the year. We get a subtotal first. Then we divide by 2. If you don't get the subtotal first, you're going to come up with a number that's not the average, right? The average needs to be somewhere in between the beginning and the ending. So if you didn't get the subtotal first, you're going to get an amount higher than the 225,248. So that's how you know it's wrong if it doesn't fall in between. So 193,948 is our average total assets. All right, so return on assets is net income divided by your average total assets. And we had the net income, we found that on the income statement when we did the profit margin percentage. So we're going to divide that 11,588 gets divided by the average total assets. So 0.06. We want to show that as a percentage. Go out 2 decimal places. Actually, it's 5.97. So just about 6%, or actually to be more accurate, so this is why I want you to show the 2 decimal places. So 5.97% is what they are earning on their investment of $193,948,000,000 of assets. So that's what they're getting back. And again, this doesn't mean as much as looking at that number, right? We could compare it to last year's return on assets to see, are we trending upward? Are we trending downward? Are we remaining stable? Or compare it to the industry average. For your project, you're going to be comparing it to another company. Next, we've got the return on equity calculation. So the return on equity is showing the return the stockholders are getting for their investment in the company's stock. So we take our net income and we divide it by our average stockholders' equity. So again, we need the beginning stockholders' equity plus the ending stockholders' equity, get a subtotal, divide by 2. Okay. Technically, we're talking about the common stockholders' equity. You'll see in the video that I've provided that gives an explanation of the individual ratios. They talk about preferred dividends. Our companies that we're working with don't have preferred stock, so there's no preferred dividend. So if you see that in the other video, you can assume 0. The answer is 0 for preferred dividends. Let's take a look at Amazon's. So we'll talk about stockholders' equity in more depth in a later chapter, but here you can see preferred stock, they have permission to issue 500 shares, but they have not issued any preferred stock. They only have common stock. So to get our average stockholders' equity, again, we take the 2018 stockholders' equity and add the 2019 stockholders' equity, divide by 2. So 43,549 plus 62,060. We get a subtotal. Divide by 2, 52,804.5. That's our average stockholders' equity. Again, it falls in between the beginning and the ending. Okay, and so we know our net income is 11,588, and we can divide. So turn that into a percentage with 2 decimal places. So 21.95% is the return on the stockholder investment in the stockholder's equity. And the difference between the return on assets and the return on equity, this is what we call our financial leverage. So only about a 6% return on assets and an almost 22% on equity. That difference there, that 16%, that was from them using debt in their company to make money. So you can't think of debt being as a bad thing. You can't be afraid to borrow. If you can borrow and earn more with your company than what you have to pay back in interest, you're coming up ahead. So that's why the difference between return on assets and return on equity. Our last ratio is the PE ratio. So the PE ratio shows what investors are willing to pay for $1 of earnings. So we take our market price per share, what does 1 share of stock sell for, divided by the earnings per share. What's the net income attributable to 1 share of stock? And the earnings per share you can find on your income statement. It's shown at the bottom of your income statement. So on your income statement, underneath your net income, there's basic earnings per share and diluted earnings per share. We're going to use the basic earnings per share. Anyone that's going to go on and be an accounting major, when you go to intermediate accounting, you'll learn the difference between the two. So we're going to use that 23.46. And then we need to find the market price per share. And we want the market price per share on December 31st, 2019, because that's our year end. So I like to go to Yahoo Finance. That's the site I like to use to find the market price per share on a specific date. And so if you come here, you can start typing in, if you know the stock symbol, you can type in the stock symbol, but if you don't, you can start typing in the company's name and the stock symbol will come up. And then when you come to the stock price, this is the stock price today. We want the stock price December 31st, 2019. That's when we're doing our analysis. So you want to go to historical data, and then you got to change the date. So we want it for December 31st, so I'm going to put it in, we'll get a weird thing. I'm going to put in December 30th, 2019 as the start date, and I'll do January 1st, or January 5th, 2020 if you hit done, and then apply. And then it shows you the stock prices. So here we want it December 31st, 2019. I'm going to use let's use the adjusted closing price. Oh, you know what? I put in Apple. I thought that was really low. Actually, we want Amazon. So we want Amazon, AMZN is the stock price, and I got to change the date here. So we do done and apply. Yep, I thought that price was very low, and it is. December 31st, they haven't had any dividends, so $1,847.84 for 1 share of stock of Amazon, a really expensive stock. So we can divide and so investors are willing to pay $78.77 to get $1 of earnings from Amazon. So we can see this is an expensive stock. They're willing to pay a lot just to get $1 of earnings, but that's because investors have high expectations for Amazon. So a lot of times analysts, they're looking for a lower PE ratio to find a stock that they think is going to be a good value. Maybe they think the stock is going to take off in the future, but we can see high expectations for Amazon stock. So I hope this helps with your analysis for your project.